Credit rating agencies and their role in the financial industry. Hello and welcome. In this video, we are diving into the world of credit rating agencies. Whether you are an investor, a student, or just curious about how the financial world works, this video will break down everything you need to know about credit rating agencies, their role, and their impact on the global economy. In our daily life, we encounter various rating systems. When we study at school or high school, we are marked based on the result to compare them to our peers. As we get older, we may be required to provide certain certifications to prove our abilities. To demonstrate English proficiency, we take the IELTS. For accounting, we pursue the ACCA. And for finance, we opt for the CFA. However, employers are not curious about colorful papers themselves, but scores and grades on them. Credit rating is something similar. Definition of credit rating. Credit rating is an analysis of the credit risks associated with a financial instrument or a financial entity. Credit rating is typically expressed as a score or rating that helps lenders, such as banks or credit companies, assess the risk of lending money to an individual or company. Apparently, this job is done by credit rating agencies. What exactly are credit rating agencies? Credit rating agencies, or CRAs, are independent organizations that assess the creditworthiness of borrowers. Whether they are corporations, governments, or even individuals. They assign ratings that reflect how likely a borrower is to repay their debt. These ratings help investors and lenders make informed decisions on whether to lend money to a borrower. 3 international top rating agencies, Standard & Poor's, Moody's Investors Service, and Fitch Ratings, are the 3 most significant rating agencies in the world. The Big 3 credit rating agencies are controlling approximately 95% of the ratings business. The U.S. Securities and Exchange Commission officially recognized these 3 agencies as nationally recognized statistical rating organizations in 1975, acknowledging their significance in providing credible and influential credit ratings. Each agency has its own ratings system that does not necessarily equate to another company's rating scale, but they are all similar. Fitch and Standard & Poor's use AAA for the highest credit quality, AA for the next best, followed by A, and then BBB for good credit. Everything below BBB is considered speculative or worse, giving them high yield or junk grade down to AD rating, which indicates default. Let's look at an example of how a company's credit rating might change over time. Imagine a company that starts with a stable rating of A. Over the years, the company expands its operations, increases profits, and diversifies its market reach. As a result, its credit rating might improve to AA. However, if the company faces a significant financial crisis or a downturn in its industry, its rating could drop to BBB or even lower. So, why do these ratings matter? Credit ratings have a significant impact on financial markets. A high credit rating allows companies and governments to borrow at lower interest rates, saving them money. On the other hand, a lower rating can result in higher borrowing costs and limit access to capital. This means that good credit rating leads to lower risk premium and subsequently lower interest rate. On the other hand, poor credit rating leads to higher risk premium and higher interest rate. On consumer level, agencies' ratings are used by banks to determine the risk premium to be charged on loans and bonds. On corporate level, Companies must find rating agency to rate their debt if they want to issue a security. Investors' decisions on companies' securities usually rely on the ratings. The ratings are considered more reliable and accurate since rating agencies such as Moody's or RAM have access to a lot of information that is not publicly available. On country level, investors rely on the ratings given by the credit rating agencies to make investment decisions. Countries' good credit rating can help to access high-value international investors. Favorable rating may also attract other forms of investments, like foreign direct investments to a country. Despite their pivotal role in financial markets, rating agencies have faced significant criticisms and controversies over the years. One of the most notable criticisms is their failure to accurately assess the risks associated with certain types of securities, particularly mortgage-backed securities, MBS, leading up to the 2008 financial crisis. Many rating agencies assigned high credit ratings to MBS, which later turned out to be high-risk investments, contributing to the collapse of the housing market and subsequent financial turmoil. Moreover, some argue that because agencies are paid by the companies they rate, there's a potential conflict of interest. This has led to calls for more regulation and transparency in the industry. Here's a fun fact. Did you know that the US government has a AAA rating from Moody's and Fitch, but S&P downgraded it to AA+ in 2011? This caused a huge stir in the financial world and shows just how powerful these ratings can be. On August 1, 2023, Fitch Ratings, one of only 3 private credit rating firms, downgraded its U.S. credit rating from AAA to AA+, second time in nation's history. And that's it. You now have a better understanding of credit rating agencies. If you found this video helpful, don't forget to like, share, and subscribe for more quick lessons on finance. Thanks for watching, and I'll see you in the next video.